Welcome to This Explainer. Today, we are taking over 100 pages of dense financial literacy curriculum and expert market insights, and we're boiling it all down into one universal blueprint for building long-term wealth. We're going to completely strip away all that confusing Wall Street jargon and just give you the pure, actionable mechanics of personal finance.
We're going to tackle this as a logical pyramid. So we'll start at the very bottom with building the financial blueprint. Then we'll move up to mastering credit and debt, protecting your hard-earned wealth, unlocking the magic of compound interest, and finally reaching the top with growth investing in index funds.
All right, Section 1, building the financial blueprint and setting your foundation. Because look, you absolutely cannot build a skyscraper on a shaky foundation, right? You have to manage the money coming in first.
And the best way to do that is the 50-30-20 rule. It's basically the universal starting point for any financial journey, and it gives every single dollar you earn a clear, structured purpose. But keep in mind, this framework strictly applies to your after-tax income. We are only talking about the actual money that hits your bank account on payday.
So if you run your numbers and realize your basic needs are pushing way past that 50% mark, you know exactly where you have to start auditing your spending. And hey, you don't necessarily have to pack up and move to a cheaper apartment right away. Sometimes it's just about checking the per-unit pricing at the grocery store or making a quick 5-minute phone call to negotiate a better rate on your internet bill. Those tiny little adjustments free up the capital you desperately need to fund that crucial 20% savings slice.
Moving right along to Section 2, mastering credit and debt and understanding your financial leverage. A lot of people think all debt is bad, but taking out a loan is not inherently evil. It's just a tool. The absolutely crucial point here is understanding the stark contrast between borrowing to build your future versus borrowing to fund immediate gratification. Good debt is essentially an investment. If you're taking out a mortgage to buy an appreciating asset or funding an education that's going to drastically increase your earning potential, you're using leverage effectively. Bad debt, on the other hand, is a financial anchor dragging you straight to the bottom.
Just think about this terrifying number, 300 to 800%. That is the annual percentage rate, or APR, of a typical payday loan. It is a massive, incredibly dangerous trap of revolving credit that you have got to avoid at all costs. When you're paying hundreds of percent in interest, you are mathematically guaranteeing your own wealth destruction. It's a vicious cycle where your future income is literally already spent before you even earn it. No way around it. Stay away.
Now, to actually qualify for that good debt we talked about, you need a rock-solid credit score. In the US, this maxes out at 850. And honestly, just paying your bills on time and keeping your credit utilization extremely low makes up the vast majority of your score. But you know what the most surprising fact here is? Your actual income has absolutely zero weight in this breakdown. None. It doesn't matter how much money you make, it only matters how reliably you manage the credit you already have.
Okay, Section 3, protecting your hard-earned wealth and mitigating life's inevitable risks. Now that our budget is set and our credit is healthy, we have to play some defense. Because let's be real, life happens. You can manage daily risks through safe habits, sure, but for massive potential losses, like a sudden medical emergency or a property fire, transferring that risk via insurance is your ultimate financial shield. You basically pay a totally manageable premium right now, so you are completely wiped out by a massive, unexpected bill later on.
And right alongside having good insurance, you need to hit this number, 3 to 6. Before you even think about investing a single dime, you must aggressively save 3 to 6 months' worth of living expenses in a highly accessible emergency fund. If you lose your job or your car engine just randomly blows up, you do not want to be forced back into that terrible high-interest debt. This cash cushion is your absolute financial bedrock.
Which brings us to Section 4, the magic of compound interest. This is where we finally transition from just saving to actually investing. We are now entering the engine of our pyramid, multiplying our wealth using what Albert Einstein supposedly called the eighth wonder of the world. Let's look at a quick story of two coworkers. Jasmine actually invests double the monthly amount that Miguel does, but she starts a whole decade later. Miguel just quietly sets up an automatic $25 transfer from his very first paycheck and basically forgets about it. Jasmine enjoys her money for 10 years, gets totally anxious about retirement, and then starts dumping in $50 a month to try and catch up. So, what happens? Miguel wins. He ends up with $168,000, despite contributing far fewer total dollars out of his own pocket. And this perfectly illustrates why time in the market is vastly more important than timing the market. His smaller,
Earlier contributions just kept compounding upon themselves. His money was silently working for him for an extra 10 years, generating returns on top of returns. It's like a snowball rolling down a hill.
And finally, Section 5, Growth Investing with Index Funds. We have reached the peak of the pyramid. To get that crazy compounding growth Miguel had, we look globally to the stock market. But we are specifically avoiding the super risky gamble of picking individual stocks. Seriously, skip it. Whether you're looking at the S&P 500 in the US or the Nifty 50 in India, index funds manage your risk across entire industries by pulling the absolute largest companies together. You don't need to hire a team of Wall Street analysts to predict the next big winner. Instead, you just buy a tiny slice of all the biggest winners at the exact same time.
Think about how brilliant this is. An index, like the Nifty 50, uses a dynamic weighting system. That means it automatically puts more of your money into the heavy hitters that are actually growing and less into the ones that are shrinking. If you invest $100, almost $12 automatically goes into the biggest, most successful company, while mere cents go to the company at the bottom of the top 50. As these companies grow or shrink over time, the index literally self-corrects without you having to lift a single finger.
And if we zoom out and map this strategy over 20 years, the results are staggering. Yes, there are terrifying short-term drops where novice investors usually panic and sell, like the dot-com crash in 2003. It's so easy to get spooked and pull your cash out when that happens, right? But if you just held on, the system of the market itself, the natural upward trajectory of top-tier global businesses, delivered a massive 10 times return on that initial investment.
Now, a quick pro tip. When you're actually ready to buy into these funds, always opt for direct plans over regular plans. You want to avoid paying unnecessary commissions to middlemen. Those tiny little broker fees might sound totally harmless at first glance, but when you project them over 30 or 40 years of compounding growth, they will silently eat away a massive chunk of your final wealth.
Just to put that into perspective, incredibly efficient funds will charge an expense ratio as low as 0.06%. That means almost every single penny you invest is out there actively working in the market for you. You're paying a microscopic fraction for a fund manager to seamlessly track the index, deploy your capital automatically, and secure your financial future. It's an absolute no-brainer.
Ultimately, mastering this pyramid proves that wealth is not about finding some magic get-rich-quick scheme. It's about adopting the systems and habits that force your money to build your future for you. The entire blueprint is right here in your hands. So I'll leave you with this. Are you going to keep working for your money? Or is today the day you finally make your money start working for you?